Okay, let's got a few things to get through today, so I think we'll begin. Everybody's here though. Let me see. If you see anybody popping up, it's waiting, just let me know, because I don't always see it. Okay, so let's look at the market, right? So when we looked at this last week, I was painting out a couple of different scenarios so we could come down, find an area of support, and then move up, and then that would be a good move. We're at an area of resistance zone, so it doesn't always work out that it hits the resistance line, then comes in. Oftentimes, it'll go through, and that's what creates the bull traps and bear traps and stuff like that. So if it does get turned away at resistance, and then either we come down, find support, move back up, well, that's one option, or we continue the bear market, and it just continues to go down. So technically, we're still in a bear market, but certainly this rise here is very constructive. Just a pattern of these lows as it's made its way up, but we're at a critical point in the markets right now. So there's the 200 days here. So we're still below the 200, and we definitely need to get above that to really start thinking about long-term bull mentality. And then we've also got areas of resistance here. So looking at this, so the market could still find resistance anywhere from that, like just about 4,300 area up to about 45. So 43 to 4,500 is an area that the market needs to get above comfortably on volume. And you can see the volume has been dropping off in the last few days. It's actually been dropping off earlier. So this little rise here has been lower volume, which doesn't really support an upward move. However, obviously, from a canceling perspective, they went back from uptrend under pressure to market and uptrend. So if you're following that, you should be enjoying a little bit of a relief rally here. In the bigger picture, we'll have to see how this pans out. And it looks like the next 2 weeks are probably going to be critical because we're through earnings, we're kind of through the big news items with CPI, PPI, job numbers, farm numbers, all that kind of stuff in the economy. We've already had the GDP print so we've had back-to-back quarters of negative. So technically, we are in a recession as defined by the NBER, although it doesn't feel like a recession at the moment. So what that means in the big picture, let's go to the real big picture for you. Okay, just loading up another chart. Grab it. Okay, so you're seeing the S&P. All right, so I still think we're looking at something similar to 2000. So let's go to the 2000 market. So okay, let's talk about 2008 for a second. So 2008, we got a 57% drop. It took 1.4 years duration. And you can see we came down from the peaks. We had a initial support zone, but it was down about 18% on that one. And then it had a nice little recovery up to just for those averages. So then it looked like it was down by 7.5%. So it was looking good. And then once it got to there, then you can see it starts to roll over, and then from here, the big drop came down, many weeks afterwards, right? So we could be in an area where we just did this little move here, and if we get turned away at resistance, and then we start breaking back down, and bear in mind that August and September, the 2 weakest months of the year. So if we get turned away here, and then October, you could see something like this, and then we can see a big drop. So all of this is still a possibility, and it's plausible. So it's plausible and it's possible. And the counter argument would be we would have to get above our current market highs. Let's go back further. This one. So here's the big 2000 drop. So this one on the peak, peak was a little bit above from the top here. So the initial down move off 17, we'll rally here. Then we got to the bear market at 27%. So we kind of got to something similar this time around. And then from here, we had a nice little elongated run. Got back to about 12% of the highs, which is almost similar to where we are now. And then from here, it gave it up. So that was like you can, this was one leg down. This was second leg down. And then we had our third leg down. So this is a classic bear market. And you can see this one took over 2 years from peak to trough. And then it took some time to get itself sorted out before it went up. So we came down to about 28, bounced back up to within 12%, and then we started giving it up. In our current market, you can see we came down to about 25%, so close to the 27%. And we've since then bounced back up. We're about just under 12% down. So very similar to the 2000 market. I'm not saying that's how it's going to go. It's just something to be aware of, right? Because, I mean, IBD's methodology will get you out from a candlestick perspective because you'll get distribution days and it'll get you out. If you're not following that, then you need to be cognizant that unless we can get above this level here, then we're in a different ball game. So we have to get back up to the highs. The high print was around 4,800. Let's mark that. So 4,800 gets us above that, will get us into new high. The most recent peak was around there, 46. So this was what the value we were watching when we were down here, 4,300. Now we've got a base around 36.15. Okay, so one other thing to note is, so down here, where we had 22. So this would take us to about 2,200. A lot of the talking heads are saying that around 32. So that's around 3,200 is what they're projecting the low to be. So if that's the case, we still got another down leg. And the other thing to note is that we have not had capitulation. There hasn't been panic. There hasn't been any major rush for the exits. So you got to bear that in mind. Most most real bear markets don't just peter out without some final flush, which usually means hedge funds blow up and you have redemptions. And there's usually one sacrificial lamb. Every bear market, there's a sacrificial lamb that goes to the wall with Lehman Brothers in the last one. And then we had a ton of them in like Petco, in the .com. So the 87. So every bear market you can look at this. There's been one notable, sacrificial lamb. Company just blew up along with the major hedge funds. So we haven't had that. So, and technically in recession, if you look at the macro picture, as I pointed out, nothing's changed, right? So you still got the conflict in Europe. Europe's still suffering from energy pricing. The world is still suffering from the global supply chain shocks. Those are still ongoing. Yeah, and we've got a particularly strong dollar because the rest of the currencies are weak right now. And then we've got, in addition to that, we've got all this like geopolitics, sanction-wise, etc. So if you've been following all of that, and you just say, okay, today, what's different today than say 2 months ago? All of that is still in place. So what's the market sniffing out that it thinks things are okay to just walk up? Because oil is still over $100. So it's just something to kind of make sure you have in the back of your mind as we go forward, right?